Good morning and welcome to the ReFuels investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives in the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Philip Feld, CEO. Good morning to you, sir.
Good morning. Thank you, and good morning to everyone who's taking the time to follow us and view what we have been up to for our January to March quarter. So I'll just move us on here. So just a bit of a reminder, really, who we are, what we do. As of today, our focus is around decarbonization transport, and that is predominantly the very heavy part of the heavy goods vehicle sector in the UK. We've got 14 refueling stations operational today across the UK. Got one more in build. Talk a bit more about our ambitions beyond just having one more in build. We've got north of 1,700 vehicles on the road today, or our customers have, that use our stations exclusively. Over the last 12 months, we saved north of 135,000 tonnes of greenhouse gas emissions, or we helped our customers save 135,000 tonnes of greenhouse gas emissions through our operations, which is something that we're very proud of and which will continue to grow going forward. Just a brief recap, or maybe reminder, as to what one of our stations looks like. This is our Newton Aycliffe station up in the northeast, up in County Durham. This is on a 2-acre plot, so 8,000 square meters in total size. I think what's important to understand here, because sometimes we get questions, well, why doesn't someone who has a regular petrol or diesel forecourt, why don't they just plonk down 1 or 2 CNG dispensers, and hence you've got a competitor? Well, if you look at the scale that we operate at, we are predominantly a truck-only refueling facility. And as such, the scale you need to operate, the land you need, the capacity of the gas pipeline you need to connect to, the electrical connection, and so on and so forth. And if you look at this station alone, we can refuel 14 trucks simultaneously, 80 trucks per hour. Fill time is very, very similar to diesel, maybe 1 to 2 minutes longer, but pretty much on par. And through a day, this station can refuel 700, maybe 800 trucks per day. Some of the key highlights from the quarter: we had strong underlying growth, close to 50%, comparing year-on-year growth. If you then look at the EBITDA and the annualized EBITDA from the station portfolio, Baden will touch upon that a bit later on. We annualized £7 million in March. Going forward, we're expecting that to go north of £1 million as we get to the end of per month, as we get to the end of 2024. On our certificate generation and trading, we are seeing signs of recovery in the biodiesel sector, or at least that sector balancing, and that is supportive of the RTFC pricing. We opened 1 new station. We also have a first private station, which we'll touch upon briefly. And then, as I also mentioned, we have another one in build currently. Our plans to put a lot more into build in a bit. And we've already got firm plans for 5 large higher capacity stations to go into build later in 2024. And finally, we have been progressing discussions to consolidate the station network. Currently, 13 out of those 14 stations that are operational sit outside of our balance sheet through a joint venture with Foresight. We'll also provide an update on that. And then something that we are very, very excited by, and this is in addition, and this has happened since we actually presented our quarterly results on Friday last week. There is a very large truck show in the UK this week. This is a picture. I attended there on Tuesday. This is a picture of a 6x2, so a vehicle that can go up to 44 tons in total combination weight. And this is the first 6x2 Scania that has been brought into the country. We are extremely excited by this. This is something we've been waiting on for 5 to 6 years, and is going to be a true game changer in growth going forward and in penetration into market segments that we today are unable to address with bio-CNG as a fuel. I'll touch upon that a bit later on the difference between a 4x2 and a 6x2. But once again, a game changer. The way we see this, it's not going to have an immediate impact on growth and volume, because of course it takes time for these orders to come through. But from 2025 onwards, we're expecting this to really start to move the needle. If we then go back to some of the key figures for the quarter, you can see pretty much growth all along the path here. I think what's the one I'd like to highlight here is maybe the unique customer fleets. Where we've now got to as a company, we founded the company 10 years ago, is that we are now in a world of true mass adoption. Not just true mass adoption amongst the large corporate fleets, but true mass adoption from a perspective where we are now also attracting and addressing demand from the second and third tier fleets, the smaller fleets, the family-owned businesses that run 20, 50, 100 trucks, etc. And that will just continue to expand going forward. And that's, of course, a validation of bio-CNG as a great fuel choice, that the trucks work, our station network is good, there are indeed tangible economics that work, and also the greenhouse gas savings, which once again, we expect once the 6x2 truly comes into production, because that is the preferred truck in the UK, that once again, our customer base will continue to broaden. If you look at the overall growth that we've had, we founded the company 10 years ago. It took us about 6, maybe 7 years to really start to see liftoff, where we got to a critical mass of stations and critical mass of number of companies, customers out there that were willing to move away from diesel and over to bio-CNG. In this graph, you see we have something called MRS volume, and we've got station volume. And MRS is something that's important to us. Touch upon that shortly and explain exactly what it is. But that is a solution that means that we can pull forward customer demand ahead of actually having stations, large public access grid connected stations, similar to the picture you saw some slides ago. And the MRS on this slide is this solution. Why? Because we can put a mobile refueling station onto a customer depot. A customer can run up to 100 trucks a day through it. Our busiest one at the moment runs a bit more than 100. I think it's about 110 trucks a day. So we can put it on that depot so that that customer can order and pull forward truck orders whilst we are developing the public access station on their doorstep, which could be half a mile away, a mile away. Once then the public access station goes live, we remove the MRS and redeploy it, excuse me, redeploy that elsewhere. This is a solution that we developed in 2020. We had a very specific requirement at that point in time, which was for a very large customer in the Milton Keynes area, the Magna Park distribution center complex there, where we've got 2 installed. We didn't really think we would ever need more than 2, but it's become such an elegant and such an efficient and such a reliable solution that we've now got 7 in operation. We've got 2 in spare because we, of course, need to maintain them and rotate them. We've got more in build this year, so probably sometime in 2025, we should be north of 10 of these in operation across the country. We have developed our first on-depot private station for Waitrose at their Bracknell distribution centre. We sometimes then get the question, but hang on, Philip, you guys have said your focus is on public access. Yes, it is absolutely, that is our focus. That is where the growth will be. That is where we see the benefits of truly getting scale. But of course, we do work closely with our customers. And if our customers need a stopgap solution, before they can get to a grid connected station in the future, we will of course provide that. And that's what we've done here. We have provided a private station for Waitrose at Bracknell, which over time we will expect will become a grid connected station, and as such will move away from being a purely private station. So what have we done over the last 6 to 9 months with regards to new stations? We've opened Corby, then we've got Bangor, which is the first one in Wales, and only a couple of weeks ago we opened our first one in the southeast quadrant of England, if you want, which is Aylesford in Kent. Once again, an important station because it opens up part of the country we haven't been able to address previously, and that's off to a great start already. Why? Because we have had an MRS installed there. That MRS will now be removed, and of course we then have 60 plus trucks that are using that station on day one. And then finally we've got Doncaster that's in construction and more going into build later on this year. So the ones that we want to build later this year, just spend a minute or so explaining that. We have spent many years looking around the country, speaking to our customers, where do they need stations? We've got a land team of 5 people who only do one thing, which is go out, work with landowners, secure agreements with landowners, get planning, get surveys done, get planning permission, and basically take a site through to shovel ready. We now have a much more mature customer base as well than we had just 2, 3, 4 years ago. So the next stations that we will put into build, the way we describe them is basically high-graded station. That means that we've got a wide, a very broad portfolio of station opportunities out there, and we are now taking the best of those. I say the best under a number of categories. It comes to the economics of those stations, and of course those economics are driven by a number of factors such as land cost, where can we locate them, but also customer demand, because we've now got such a broad and I would say attractive customer base, if you want, from depth of growth and depth of fleet, that we can now choose to build the stations in locations where we will have the fastest customer uptake compared to some of the stations we've had to build in the past, which have also been built for certain strategic reasons, such as the first one in Scotland, the first one in Wales, etc., in order to open up new markets. If we then look at the stations and only station economics, so this is excluding anything that we could potentially make from certificates. The current run rate, which is based on March, annualizing the earnings in March, March is a month, is north of £7 million per annum. We have an order book, or our customers have placed orders for close to 1,000 trucks. Once those are into operation, that EBITDA, annualized EBITDA, should reach in the range of £12 million plus, so north of £1 million per month. However, if you then look at the station portfolio, and this is not including any future growth, this is just assuming that we basically stop building stations, which we won't, that takes us up to close to £50 million once those stations get to a healthy level of utilization. And of course, we've got ambitions, as I've just mentioned, to build more stations in the near future. We announced in April that we have a process ongoing to seek financing so that we can consolidate the stations that we've currently got today onto our balance sheet and move them all under one umbrella. We have had and we've got a very good relationship with Foresight Funds, who have provided the financing for currently 13 out of the 14 stations we have in operation, and of course Doncaster that is in build. We have announced that we're looking for £150 million there or thereabouts, split yet to be determined, but split between a portion of debt and a portion of equity. That process is ongoing. We're making excellent progress, and we will come back to our shareholders and back to our market once we have reached a certain milestone that we can then announce. And this is really what we're looking to do. The current structures on the left-hand side where you can see we have a joint venture, an off-balance sheet joint venture with CNG Foresight. Sorry, the joint venture is called CNG Foresight, but that is with Foresight Group for those 14 stations, 13 in operation, 1 in build. And when we then conclude this restructuring, if you want, or simplifying the structure, we will bring all of those stations in under the CNG Fuels umbrella, and thereby benefit from those going forward as they have rapidly growing cash flow generation. That will then be a benefit to us for our future rollout plans that we're looking to execute on over the coming years. And then I will hand it over to Baden.
Thank you very much, Philip. So what I thought we'd demonstrate here is the station portfolio profitability. I know we've shown this previously, and this, of course, is the CNG Foresight joint venture and how that's been performing. Over the last 3 quarters I've used here to show the growth within this year. So to put into context, we've grown about 30% in our volumes this year. And as you can see, we've had about 125% increase between Q1 and Q4 in our adjusted EBITDA. That's obviously a substantial increase, which has come down to a couple of different factors, but all of which obviously are very encouraging for the continued growth of the business. So number one, electricity has come down organically. We obviously had very high electricity prices since the sort of energy and Ukraine-Russia related crisis back in 2022. Those have come down materially, and of course, electricity is one of our key inputs. We've also improved our logistical operations, particularly in the running of our trailer fleets. We do nearly 30% of our volumes is currently driven around by the mobile refueling stations, and the improvement in the logistics there clearly brings down our costs, and boosts margins. And then, of course, a very substantial factor has also become, and to show the sort of scale benefits of the growth that we've had, is that we're now consuming more than 10 gigawatt hours per annum of electricity, which puts us in the large energy customer bracket, which has seen about an increase of about £150,000 of EBITDA per month, and has boosted our margins substantially from about 14.5% to about 18% currently. So EBITDA margins on a per kilo basis currently around 14 pence, gross profit margins around 18 pence, and that is up about 50% on the year. So very healthy margins come from the stations as we continue to build volume through them, continue to be able to share in resources to be able to run them. As Philip's mentioned before, we've got a confirmed order book of nearly 1,000 trucks now, and with those vehicles being delivered over the next 12 months, should see an increase in our EBITDA to about £1 million per month, or £12 million per annum, sometime around the end of this calendar year or end of the financial year quarter. Consolidated revenue in the quarter was down to £26.4 million. That was largely due to a 30% decrease in the gas price, or 30 or so percent decrease in the gas price in the period. Of course, gas price for us is a pass through to our customers, so it has no impact on the gross profit or on the bottom line. We delivered 38.4 million RTFCs in the period. These delivered at a volume weighted average price of about 21 pence per RTFC. This is not just as a positive margin for us in the period, but also relates to some of the previous hedging we had done in the prior year, which enabled us to recognize prices that were in fact above market prices. And we've got Philip will have a bit of a discussion on the RTFC prices later, which we've seen a substantial recovery in the last couple of months. We've recognized a gross profit of 2.8 million. That was driven primarily by the station management fees we received, sales of RTFCs, which of course are now at positive margins, and some of the natural gas prices. We did an EBITDA, negative EBITDA, which I'll show you how, in the quarter of 2.1 million, but I'll show you how we adjust that out to get to the positive EBITDA of 0.3 million pounds in the quarter. Overhead costs have increased due to an accrual we have for the bonuses, which are expected to be paid out this year. But I think we'll repeat for the benefit of new listers that we've done an exercise internally to look at what we would need in order to be able to supply the 30 to 40 stations that we have that we want to develop in the medium term. And we anticipate an overhead increase of about 15 to 20% will be enough to sustain the operations for that number of stations. So we have got massive operating leverage as we increase the number of stations and the amount of volume that's going through our sites over the years ahead. Here we show the adjusted EBITDA, which we've previously shown before with one element that's been removed, thankfully, because it was heavily distorting our earnings figures. We used to have to account for an RTFC price adjustment based on the timing of purchase and sales of RTFCs. We no longer have to do that. So that cleans up our reported EBITDA quite well. Once we adjust for share-based payments and the timing of EPC revenues, which essentially are the development contract revenues that we have earned but not yet done the work, or alternatively, occasionally done the work but not yet earned. So we adjust those out. We see we have an adjusted EBITDA of about £300,000, and obviously encouraging to return to adjusted EBITDA profitability in the quarter. Total assets, 203 million in the quarter, down about £10 million so from last quarter, but that was largely due to the 30% or so decrease in the natural gas price. So we had a corresponding decrease in liabilities in the period too. And so total equity ratio has fallen from 57% to 56% in the period. Net cash flow from operating activities was £2.5 million negative, and cash from investing about a negative 0.1. We drew £1 million from the Foresight facility, which was £6 million drawn up to the end of 31st of March. So still had availability up to the £10 million, of working capital available there. The group held £4.3 million in cash at the end of the period. Thank you. I'll hand back to Philip.
Thanks, Baden. So let's just take a brief look at the market that we operate in. In general, our market, or we say our market, is for trucks above 18 tons. However, when you look at that market and the market segmentation between rigid, which is the light blue on the left-hand side, and 4x2 and 6x2 trucks, which are the articulated trucks in the marketplace, our core market is the 4x2 and the 6x2 truck market, which I'll touch upon briefly. That does not mean that we are not focused on the rigid market, or that we do not have customers who want to grow their CNG fleet in the rigid market. On the contrary, a couple of years ago, had you asked us, we probably wouldn't have said, or we would probably have said we don't expect a lot of growth within the rigid segment. However, that's wrong. We are now seeing growth that is surprising us, but the majority and the bread and butter of our growth, if you want, is going to be within the 4x2 and the 6x2 market going forward. So what are the advantages here for our customers? Two advantages. One, yes, a CNG truck is more expensive to buy than a diesel truck, but the fuel is considerably cheaper. And because you have a fuel portion of your overall cost of running a truck is so much cheaper, you typically have a payback period of your additional capex for that truck in the range of 1 to 2 years. Average savings for our customers, if you were to drive an imaginary diesel truck 1 mile or 10 miles, and you were to drive an imaginary CNG truck 10 miles, the savings of operating that truck would be about 30%, and has been 30% historically. Currently, we're sitting above those 30%, and that's also one of the driving factors for why customers here are so keen to continue to order, because here they get the benefit of running on 100% renewable and sustainable gas, and also having attractive economics compared to running a diesel baseline vehicle. We spent a lot of time talking, or I've mentioned the 6x2, and I'll continue to mention it because it's such an exciting thing for us. And as I said, I don't really like using the word game changer, but there's really no other way of describing how important that 6x2 vehicle is for the UK market. If you look at the typical usage of a 4x2 vehicle today, an average vehicle uses about 32 tons or 32,000 kilograms of gas per annum. That contributes close to £6,000 of gross profit per truck for us as it goes through per annum, as it goes through our station network. However, a 6x2 vehicle operates in a heavier part of the fleet operations. As such, does heavier work, consumes more fuel, needs more energy. And as such, as 6x2 vehicles come through and start to get into the customer hands here eventually, we are expecting that the average fuel used per vehicle per annum through our station network will go up. And of course, if you look at a 6x2 vehicle, it will use, on average, we estimate about 45,000 kilograms, which again increases our gross profit margin significantly. So what is a 4x2 and what is a 6x2? Well, if you look at the 4x2, which you see on the left-hand side here, that is a tractor and trailer combination where the tractor unit has one rear axle. That means that it can typically operate up to 38 tons in combination weight. That is 14%, so the total market of a 4x2, this is including all fuel types, where of course the majority are diesel still, makes up 14% of the articulated truck market in the UK, 21,000 trucks in total. On the right-hand side here, you see one of our demo trucks, 6x2 demo trucks. It has two rear axles and can operate up to 44-ton total combination weight. Now, you might say 38 tons for a 4x2, 44 tons for a 6x2. It's only 6 tons. What's the big difference? If you do 6 tons of additional payload, and you can do that twice a day over 340, 350 operational days a year, you're into thousands of tons of additional payload during a year. So it is a big deal. 86% of the UK articulated market, truck market, is a 6x2 market. And as of today, we've got about 50 6x2s on the road. And these aren't factory built either. There are modifications that need to be done after the factory line. That total market is 124,000. Huge market that we today have been unable to penetrate. With the Scania factory built 6x2 being launched or being presented for the first time on Tuesday this week, it opens up that door to us so that we can now start to penetrate the 6x2 market the way we have the 4x2 market. We estimate that by the end of 2024, we will have approximately 10% of the total 4x2 market running through our network. If we can achieve that in the 6x2 market over time, well, you can do the math, what that means for us. If we then look at orders going forward, our customers are running today north of 1,700 trucks through our network. We know that those customers have ordered close to 1,000 trucks that will be delivered over the next 12 plus months. And then we know that a number of our large customers have indicated to us that they will continue to order trucks. Well, we expect them to, but they've indicated their order plans for 2025 and 26. Well, you might say, well, hang on, why haven't they ordered trucks for 25 and 26 now? Well, typically you would order trucks 6 to 9, maybe 12 months in advance, but usually 6 to 9 months. So if you need a vehicle on the road, second half 2025, you're not going to order that vehicle before probably late 24 or very early 25. We spent a bit of time in the past talking about, the biodiesel market and why that's so important to us. You've got to remember that we generate a lot of RTFCs, renewable transport fuel certificates, and the value or the price of those certificates is determined by the price spread of 1 litre of fossil diesel and 1 litre of waste-derived biodiesel. Due to factors outside of our control, that market crashed, or the biodiesel market crashed in 2023, and thereby severely depressing the RTFC prices. What we are now starting to see is a recovery in some of the biodiesel market fundamentals. The EU is now investigating flows of biodiesel from China through an anti-dumping investigation. The UK announced yesterday that they are doing exactly the same. So as such, there are there is positive direction at the moment that the market is rebalancing, that this wave of allegedly fraudulent biodiesel, or a lot of it was alleged to be fraudulent biodiesel that came in 2023, is washing through the market. And as such, we are starting to see more supportive fundamentals for what we can achieve going forward in the RTFC market. If you look at where RTFCs are trading, they're currently trading in the 20-ish range, maybe a bit more currently. And that is important to us because that means that, of course, the margins that we can make from sourcing biomethane will start to increase again. So here we're showing margins back from 2021. The average margin has been about 30% per annum. 30% margin on sourcing of biomethane. Currently, we're below that, but with the seemingly steadily increasing and improving market fundamentals, we are now seeing these prices start to recover, and our margins are starting to recover. And an important aspect to remember here is because our volume has grown so much in 2022, 23, and continues to grow month on month going forward, we don't need to get up to 30 or 40% margin in order for that to have a significant impact on our earnings. No, because the volume component now has doubled, or at least grown more than 100% since the last time prices were at sensible levels. We're only a marginal and I would say fairly small recovery in RTFC values and increase in margins will have a outsized impact on our earnings and cash flow generation going forward. So just to summarize, before we take some questions, there's no doubt we've got a strong market leadership in the UK and very strong market position in the UK. That's taken many years to build. Now we are coming into a phase where we can actually harvest some of those benefits and harvest some of those seeds that we've been planting over the years. We're starting to see a strong networking effect now from the station network. True economies of scale are coming through now. Baden mentioned previously how our EBITDA margins and how our margins in general have increased dramatically, I'd say, over the last 12 months. And Baden also highlighted, we've got huge operational leverage in the business. We need maybe 15 to 20% additional headcount to operate a station network that is close to 3x of what we've got today. So once again, we will start to reap the benefits of that very soon, and pretty excited about that going forward. We are today focused on the UK market. We won't be tapped out on growth there for a very long time to come. But our focus isn't only on the UK. Over the next couple of years, we will also probably or likely start to get involved in some projects across the EU. But our focus for now is in the UK. We've got a medium-term target of 30 to 40 stations and then continued growth beyond that. Finally, strong underlying growth that will continue going forward. Very excited about the visibility we have on orders from our customers. Progressing attractive sites. We've got 5 more we want to put into build very soon and then continue to roll out more attractive sites from 2025 onwards. And finally, probably repeating myself for the umpteenth time now, but the 6x2 that was released this week cannot highlight enough what impact that will have on the business and on the overall ecosystem that we've created here going forward. We've already got a list of close to 100 fleets that want to demo that vehicle or that type of vehicle as soon as it is put on the road shortly after the summer break. And with that, we will conclude the presentation and see if there are any questions.
Perfect. Philip, Baden, thank you very much for the presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. Just while the company take a few minutes to read the questions that have been submitted today, I'd like to remind you that the recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions throughout today's presentation. And Philip, Baden, if I could just ask you to read out those questions and give responses where it is appropriate to do so, I'll pick up from you both at the end.
Thank you very much. Yeah, I'll get going here. Can you explain the changes in fundamentals that you think will help RTFC prices? Well, touched upon some of them. Going back to some of the basics again, we are, exposed, whether you like it or not, to the direction of biodiesel pricing, because that is essentially what determines the RTFC price, or the RTFC value. We are seeing the market, or seemingly seeing the market, becoming more balanced between supply and demand. Flows from Asia, I wouldn't say they've stopped, but are greatly reduced. There are ongoing investigations here to weed out the flows that probably shouldn't have occurred in 2023, and as such, there is a more positive backdrop. Probably like to highlight a couple of other things as well, which aren't immediate, but which will have an impact from 2025 onwards. There is a sustainable aviation fuel mandate that will be implemented in the UK and the EU from the 1st of January 2025 onwards. Why is that relevant to us? Because a lot of the feedstocks, used cooking oil and tallow typically, that today are used to make road biodiesel, are expected to go into the sustainable aviation fuel sector and be used there to produce sustainable aviation fuel. Why do we believe that? Because the sustainable aviation fuel sector is expected to pay well in excess of what the road biodiesel sector can do. So as such, of course, feedstocks will flow to the best paying market. And we believe that will structurally start to tighten the road biodiesel market from 2025 onwards. The exact timelines of that are, of course, beyond our crystal ball gazing here, but that we are expecting a structural tightening to take place in 25 and 26, which should also have a positive impact on these fundamentals going forward. Second question, do you think the truck manufacturers will be able to produce enough 6x2s? And the simple answer is yes, for the following reasons. When the truck manufacturers produce a CNG truck, it is essentially produced on the same production line as a diesel vehicle. There are certain components need to be changed out, but we're not talking here about a complete separate production line in a complete that needs to be built up, retooled, and so on and so forth. Having spoken to the truck manufacturers without giving out too many details, they don't see any constraints from 2025 onwards to produce both 4x2s. I would like to stress that will continue to be a very important market for us. We don't want to talk down the 4x2 importance to us, but where they can satisfy demand for both 4x2s and 6x2s in the future. And as such, yes, there will be a bit of time of ramp up from 2024. And I think we need to be sensible, temper everyone's expectations. It's not going to have a huge impact on trucks on the road for 2024, but the impact will be felt from 25 onwards. And that's where the truck manufacturers are telling us that they don't see any limitations on their end as to how many vehicles they can produce. Why don't you have more competition in this market if it is so attractive? And I presume that is down to someone's referring to stations, etc. Well, first of all, we believe it's an attractive market. Others can take their views. I think it's a multifaceted question, which actually has a lot of depth to it in the answers here. If you look at this from a very high level view, what we do, and you purely look at a station, and you look at we've poured some concrete, we've flattened some land, we've put some compressors on there, we've connected to the gas grid, that doesn't maybe look like it's that complex. Actually, that part of it is actually quite complex as well, because the design that we've got, the fact that we can operate them as unmanned stations, there's no one in Europe that's got a capability that we've got at the scale of the stations we've got, and the fact that we can operate our stations from a phone. So there alone, we've got a competitive advantage. But the biggest moat, if you want, or our biggest competitive advantage here is access to land. It's access to the customer base. It's the knowledge that we've built up. We've got sites that we would like to build urgently that we've been going at for 7 to 8 years and we're still not building. Why? Because securing land takes a long time, negotiating with landowners, doing all the surveys, getting a planning submission put in, getting planning approval, then discharging conditions, and then actually getting it shovel ready. So typically from someone is looking to, acquire a site and start, to take it through the process that I mentioned, that can take 2 to 3 years at best, probably longer. And then it takes 8 months to build. And that is not a function of money. So even if you've got unlimited resources and you're one of the energy majors, it's not a function of money, it's a function of time. Planning authorities don't work any faster just because you're a large energy major. Surveys take the time they take, negotiating with landowners and so on and so forth. But because we've been doing this for so long, we've got a huge land bank that we're currently maturing, moving through the stages. That is our biggest competitive advantage today, and is something that others would need to catch up on before they can even start to build their own stations. With the launch of the new 6x2, how do you see this driving your revenue, and what, if anything, is the limiting factor in capturing market share? Well, probably answered some of that already. Don't expect the 6x2 to have a meaningful impact in 2024 because it's just been launched. It will go into regular production later in 24 and really crank up production levels from 25 onwards. But yes, we do expect it will have a huge impact on earnings from 2025 onwards. Limiting factor in capturing market share there, that's a very good question. I'd probably say stations. We've got 14 in operation today, 1 more in build. We want to put 5 more in build. It gets to 20. The UK does need 100 of these large stations in order to truly penetrate and be able to address pretty much all parts of the market geographically and also segment-wise with regards to various haulage patterns. So I would say, but 20 stations is going to be is going to get us off to the races in big time with regards to 6x2 market penetration. You've got to remember, we've got today north of 150 fleets that have signed a contract with us. Some of those are still waiting for their first trucks to arrive, by the way. The vast majority of those fleets are predominantly 6x2 fleets, meaning the majority of the vehicles are 6x2s. So once the 6x2 here in big numbers from 25 onwards, we would expect those numbers to really, to really crank up, because we've already convinced a very large portion of our customer base that a 6x2 is something that they'll want to run. Let's have a look here. The funding structure to expand to the new 14 sites and site availability. What challenges do you foresee in scaling up the infrastructure? I've touched upon one of them, which is the time it takes to secure land, to run that through the process, planning approvals, and so on and so forth. The other one is, of course, financing. If we had unlimited amount of funding available, we would be building more stations today. However, would like to stress here one thing, that we do not need that much more funding in total. Yes, bringing back in the Foresight station is one thing, but on top of that, the type of growth capital we need on top of that doesn't need to be a huge check. Why do I say that? Because of the cash flow generation that will start to come off our existing network. That will really ramp up from 25 onwards, and as such puts us in a very good position to have a sensible cost of capital and a quite optimized funding structure, if you want, going forward. So we're quite excited about that. But I would say there are 2 limiting factors today. If you want, it's really about securing land and getting that into a shovel-ready state, and financing. But both of those we have a plan for, and both of those we'll be executing on over the next 12 months. With increased demand, what revenue profit do you expect from RTFCs? What's the target waiting for your model?
Okay.
I'll answer that briefly, and then I'll hand a bit over to Baden as well. I think it's important here to understand that the numbers that you've seen in the presentation, the 7 million, the 12 million, up to the 49 million, sorry, of EBITDA generation from the station portfolio does not include a single pound from RTFC generation or from profitability from biomethane. That is totally on top of that. I also mentioned, we don't need a lot of growth in RTFC values here. in order for us to see a significant ramp up and significant increase in cash flow generation. I'll just leave it at that, and maybe, you know, what's the target waiting for your model, or maybe.
I think we've previously shown in a prior presentation the kind of operating leverage we have towards the RTFC prices, when economic leverage we have towards the RTFC prices. It's not appropriate for us to guide on where we think RTFC is going to go, because we simply, that is a, you know, that's a complex market that we, and for the reasons Philip's been through, have our feelings on where we think it should head sustainably. But in, you know, as we've shown before, at the volumes we're currently at over the next 12 months or so, for every 3 or so pence above 18, 19 pence RTFC price, we generate an additional 10 million or so of EBITDA. So, you know, currently trading just over 20 pence, and obviously we'll have to see where that moves to during the rest of the course of the year. That's a crude number, of course. Things can move around in the costs and revenue side, but that is a sort of a simple back of the envelope basis for thinking about how that can affect the profitability of the business. Of course, as our volumes continue to grow, that metric then changes again for next year.
Thanks, Baden. Then we've got a question here, which is, why do the directors feel it is appropriate to increase bonus accruals when there is negative EBITDA and a significant cash flow deficit? Well, I'll, you know, answer that one. It's pretty straightforward. As for bonuses, what Baden and I get in bonuses, which are unlikely to be bonuses, to be fair, is up to the board of directors to decide, and that will, of course, heavily depend on financial metrics. If you look at the rest of the organization, however, the ones that keep stations operational, the ones that build stations and do all of the other very important work in the company, that those are not necessarily, the majority of those targets are not necessarily related to financial metrics, and shouldn't be for a company at our stage, given the growth that we've got and the importance here of operating stations with 100% uptime and so on and so forth. So I'll leave that at that, and just say that, yeah, that's that one. Here's another one. There's a lot of room to grow in the UK, but it seems that permitting is an issue. Are there any European countries with permitting and access to electricity gas networks make them more attractive than the UK? It's a good question. The answer is yes, yes and no. Permitting in the UK, or permitting challenges, are not unique to the UK. There are other European countries that have challenges, along the same lines as well. Should we then be spending more time focusing outside of the UK? Well, if you want to focus outside of the UK, you have to remember we've spent 10 years here building a customer base. We've spent 10 years here building an organization, and so on and so forth. So just because permitting here is a challenge doesn't mean that, you know, we shouldn't continue to focus on this market. And remember, these permitting challenges of something that have been really holding us back over the last 2, 3, 4 years, but we're now coming through this process, a funnel, if you want, where we're now starting to see sites drop out the other end and becoming shovel ready. And as such, we are in a very good position going forward for having permits in place to really turbocharge our growth, to get sites into construction. So yes, there are, you know, many facets to that answer, but we'll continue to focus in the UK, and we will then leverage what we do here, our expertise, our IP, across Europe, and probably do that through JV structures, etc., where we can benefit from companies that already have boots on the ground. Here's another one. To deliver growth, you need to source significant volumes of biomethane. Where will this come from, and how can you secure at the right price levels? What contracts do you have in place? How far into the future? So first of all, we are not constrained by only sourcing biomethane here in the UK. We can source, and we do source, biomethane all across Europe. As long as a biomethane facility is connected to the European pipeline grid, we can mass balance biomethane from that plant. We do not, as of today, there's more biomethane chasing transport demand than there is transport demand. So we do not see a shortage of biomethane for the next 2 to 3 years. Now, my crystal ball doesn't go out more than 2 to 3 years, but we can with confidence say that over the next 2 to 3 years, we do not expect a shortage. And I'd like to add, there is billions and billions and billions of euros being poured into, not just in the UK, but across Europe, into new production facilities. And as such, as our demand grows at our stations, production is going to grow with it. If you look at the typical type of contracts, which was part of the question, it's a complex one to answer. We have a base, and you should think of this as a layer cake. For every year that goes forward, we add long-term contracts. But matching exactly when a station opens, with exactly when trucks arrive, with exactly when new biomethane production capacity comes online, is of course impossible. So therefore, we do also rely on what we determine as the short-term biomethane market, which is somewhere between, you know, a 1 quarter's worth of supply to maybe supply through the year. That's important to us so that we can balance that. But we do have a mixed portfolio of contracts, which also gives us a mixed portfolio with regards to exposure to RTFC prices, to gas prices, etc. But yeah, we don't see a shortage of biomethane in the future, but we do expect, you know, going forward, there'll be a lot of new production capacity coming online, and we will continue to have a diverse set of supply sources. And then I think we have the final one here. What is the annual central overhead financing cost?
Yep, I'll take that one. So we think of our sort of cost base in sort of 2 parts. Again, I think this has been disclosed previously. About 6 million or so we think of as the costs of running the existing network, and the ability for us to run a larger network within the with all of our systems and our employees that can do that, and sourcing biomethane, etc. There is an additional about 3 or so million, which is which we consider to be business development and the growth, and so the growth engine that's going to deliver the business plan over the next couple of years. So if you combine that together, it's somewhere in the £9 million range. If you take our EBITDA from the stations, which is why we feel it's important to bring those back in, and of course recent improvement in RTFC revenues, we'd be very close to covering this entirely at the moment, and of course that's growing at a very rapid rate at the moment. So more than covering that very, very shortly, if not already. And then, if you look back at our discussion on what we would need for our overheads in order to maintain a portfolio of double or more the size we currently have of stations, we think that's about 15 to 20% increase. So we have excellent leverage to that growth. And as I say, we're pretty much washing our faces at the moment.
Perfect. Philip Baden, I might just jump in and thank you for answering those questions from investors. Obviously, we will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Philip, I was wondering if I could just ask you for a few closing comments.
Thank you very much. Once again, thank you to all of you who've been, who are showing an interest in the company, and for some good questions coming through. Exciting times ahead. We're of course very excited by the 6x2. We shouldn't forget, you know, the ongoing growth we've got as well. We'll come back to our shareholders over the coming weeks or month or so in updating on what we're doing on the financing side of things. But really excited about the future here. Got some really good new stations going into build soon as well. So thank you for showing an interest, and looking forward to keeping you updated as we go forward.
Perfect. Philip Baden, thank you very much for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected. Provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of ReFuels, we'd like to thank you for attending today's presentation, and good morning to you all.